You probably saw the headlines. Iran closed the Strait of Hormuz. Maybe you scrolled past it, thought it sounded serious, and went back to whatever you were doing. That's understandable. Geopolitical news feels distant until it isn't. But here's the thing, what's happening in that 21-mile wide stretch of water between Iran and Oman is going to show up in your life in ways that have nothing to do with international politics. It's going to show up at the gas pump, at the grocery store, in your investment portfolio, and in your monthly budget. And it's already started. Before we get into what this means for your money specifically, you need to understand what the Strait of Hormuz actually is, because the scale of it is hard to grasp until you see the numbers. Every single day, approximately 20 million barrels of oil pass through that narrow channel. That's not a regional figure. That's roughly 20% of everything the entire world consumes in petroleum products daily. 1 in 5 barrels of oil on the planet was moving through a passage barely wide enough for 2 tanker lanes side by side. And as of early March 2026, traffic through that passage dropped to essentially zero. On a normal day, around 138 commercial vessels transited the strait. On March 7th, 1 ship passed through. 0 oil tankers. Over 150 vessels anchored outside the strait waiting, unable to move. More than 130 container ships trapped inside the Persian Gulf with nowhere to go. This isn't a slowdown. This is a full stop on one of the most critical energy corridors on the planet. And when something like this happens, the financial ripple moves outward fast. The most immediate and visible effect is oil prices. When supply drops suddenly and demand doesn't, prices spike. That's not theory. It's basic mechanics. The global oil market was already absorbing 20 million barrels a day from this single route. There is no quick replacement for that volume. Saudi Arabia and the UAE have bypass pipelines, but their combined spare capacity covers maybe 3 to 5 million barrels per day, a fraction of what was flowing through. The rest of the world is now competing for a dramatically smaller pool of available supply. What does an oil price spike actually mean for you personally? Start with gasoline. Every $10 increase in the price of a barrel of oil translates to roughly 25 cents more per gallon at the pump. If oil jumps $40 or $50 per barrel, which is well within the range of what analysts are modeling for a prolonged closure, that's $1 to $1.25 added to every gallon you buy. For someone filling up a 15-gallon tank twice a week, that's an extra $37 to $46 per week. Over a month, that's $150 to $185 in additional fuel costs. From a single event, in a strait most people couldn't locate on a map 3 weeks ago. But gasoline is just the beginning. Oil is embedded in almost everything. Plastics, packaging, synthetic fabrics, fertilizers, pharmaceuticals, all of these depend on petroleum inputs. When oil prices rise sharply, production costs across dozens of industries rise with them. Those costs get passed to consumers. Grocery prices climb. Shipping costs climb. Anything that had to be transported, which is essentially everything you buy, gets more expensive. This is how a military conflict in the Persian Gulf becomes inflation in your monthly budget. Now let's talk about what this does to the stock market, because if you have a 401k, an IRA, or any investment account, you're already feeling this whether you've checked your balance or not. Markets don't like uncertainty, and a closure of the world's most important oil transit route is about as much uncertainty as you can inject into a global economy in a single event. Energy stocks typically surge in this environment. Companies that produce oil domestically or have reserves benefit from higher prices. But the broader market tends to pull back as investors price in slower economic growth, higher inflation, and the possibility of prolonged conflict. Airlines get hit hard. Jet fuel is their single largest cost, and there's no short-term hedge against a 40% spike in oil prices. Shipping companies, manufacturers, retailers with thin margins, all of them face pressure. Consumer spending pulls back as households feel the squeeze at the pump in the grocery store. Corporate earnings projections get revised downward, and when earnings expectations fall, stock prices follow. This isn't panic, it's math. Meanwhile, 2 assets tend to move in the opposite direction when this kind of uncertainty hits: gold and the US dollar. Gold is the oldest safe haven in the world. When people don't know what's coming, they move money into assets that hold value through chaos. The dollar strengthens because global investors treat it as the reserve currency of last resort during crises. If you hold gold in your portfolio, or if you're invested in dollar-denominated assets, you're seeing some protection against the broader market turbulence. If your portfolio is entirely in equities with no inflation protection, you're more exposed. Here's something that doesn't make headlines but matters enormously for the economy. The Strait of Hormuz wasn't just carrying crude oil. Around 20% of global liquefied natural gas trade passed through it as well, almost all of it from Qatar. Qatar is the world's second-largest LNG exporter. That gas powers homes and factories across Europe and Asia. With those supplies disrupted, natural gas prices are spiking in markets that depend on Qatari LNG. European energy prices, which were already elevated, face additional pressure. That pressure eventually transmits into goods and services that get exported to the US market. There's also a fertilizer dimension that most coverage is missing entirely. The Persian Gulf region accounts for roughly 30% of global urea exports and around 25% of ammonia exports. These are the core inputs for agricultural fertilizer. When fertilizer costs spike, farming costs spike. When farming costs spike, food prices follow, with a lag of several months, which means the grocery store impact of what's happening right now may not fully materialize for another quarter or two. The food price increases you're seeing today are just the early wave. Now the question that actually matters, what do you do with this information? First, don't panic sell your investments. The history of geopolitical crises and market reactions is clear. Markets that drop sharply on conflict news almost always recover once the situation stabilizes or resolves. Selling into a crisis locks in losses. The people who come out ahead in these situations are usually the ones who did nothing or who bought more when prices dropped. Second, if you're holding significant cash, this is an environment where the purchasing power of that cash is under pressure from inflation. Sitting on cash while energy-driven inflation runs hot is a slow loss. This doesn't mean rushing into anything. It means making sure your money is positioned in assets that can keep pace with or outperform inflation over time. Broad index funds, energy sector exposure, inflation-protected securities. These are the tools worth understanding right now. Third, look at your immediate budget and identify where you're most exposed to energy prices. If you have a long commute in a gas-powered vehicle, this hits you harder than someone who works remotely or drives an electric car. If your heating is oil-based, your utility bills are going to climb. Knowing where the exposure is allows you to plan rather than react. Build a small buffer in your monthly budget for elevated fuel and grocery costs over the next several months. Don't assume this resolves quickly. Fourth, understand that this situation is still evolving. As of late March 2026, Iran has allowed ships from China, Russia, India, Iraq, and Pakistan to transit the strait. The U.S. military has begun operations to reopen the route. The outcome is uncertain. A rapid resolution means prices spike and then partially retrace. A prolonged closure means sustained inflationary pressure, slower global growth, and continued market volatility. You don't need to predict the outcome. You need to be positioned to survive either scenario without making desperate financial decisions under pressure. This is exactly why financial cushions matter. The people who are navigating this moment most calmly are the ones who had emergency funds already in place, who weren't carrying high-interest debt, and who had investment portfolios diversified enough to absorb volatility without triggering panic. A crisis of this scale doesn't create financial vulnerability. It reveals it. The preparation happened before the headlines. 20 million barrels per day. One corridor. 70% drop in tanker traffic in a matter of days. The numbers from the Strait of Hormuz are extraordinary, but what they ultimately represent is a reminder that the global economy is more fragile and more interconnected than most people think about on a normal Tuesday. Events that happen thousands of miles away land in your grocery bill, your gas tank, and your retirement account. Understanding how that transmission works isn't just interesting, it's how you make better decisions when it does. Drop a comment below with what you're watching most closely in this situation. Like the video if it changed how you're thinking about it, and subscribe if you want to keep going deeper on how global events move your money.